Hey everybody, welcome back to the show. We've got another edition of 5 Question Friday. These are questions that I get during the live show via chat. We have the live show. Normally it's every other week. It's not going to be until I think February 3rd is the next one, but I've got questions from past shows as well as questions that folks have emailed me. I've picked 5 of what I think are some of the interesting ones that apply to a lot of folks, and we cover them on a Friday. Today's Friday, so let's get going. 5 great questions. The first one, I actually received this from a number of people, and it's basically, I'm scared to death to leave my financial advisor, but I really think that's what I should do because of the fees. How do I do it? And they seem to have 2 concerns, that at least for the folks that email me. One, of course, just investing on your own. That can be scary. And for folks in or near retirement, they're wondering how exactly do they create that retirement paycheck every month. It's going to be on them now to decide what to sell, where to draw the money. That concerns them. In one case, an advisor said, look, this is really complicated and you really shouldn't be doing this. I have to make some really tricky decisions every month to decide what to sell, and you should really leave it to me. Well, maybe you should, but I came up with what I think is a really good way to deal with this potentially. So here it is, and it's this. Normally you think, okay, I'm going to end that relationship and now I'm on my own. What do I do? And I think a better strategy is to make the transition not unlike you would change banks. So if you've got a bank, a checking account, if you want to go to a different bank, you don't just close that account and then go find some other bank somewhere else and open up a checking account. You open up the new accounts first. You get them all set up. You get your direct deposits set up. If you have any automated payments, you get all those set up, everything working smoothly, and then you close your accounts at your old bank. I actually think we can apply the same principles to a financial advisor. Here's what I would do. Before you fire your current advisor, maybe even before you tell them anything, I would hire another advisor specifically to help you transition from your old advisor to handling it on your own. Basically, I'd be hiring an advisor to say, hey, I want you to help me be able to do this on my own so that in whatever, 3 months or 6 months, I can fire you, right? Be very upfront with them. And I think there are some great low-cost options. If I were doing this, I would use Mark Zorrell. Now, this is a page on my site where I've listed really just a handful. I really want to add to this. I've been saying that for years. I need to add a lot of names to this. But I should tell you up front, there's no financial relationship. I don't have any financial relationship with any of the individuals on this page. They don't pay me to be on this page. I don't get any referral fees. If that were to ever change, I would let you know. So I don't get anything from Mark Zorrell, but I've known him for a long time. You can see his cost. It may be hard to read. If it hasn't changed, you should want to always confirm. But it's $2.99 the first year. Then after that, it's $8 a month. Now it's via Zoom, and you're going to connect your accounts to the planning tool he uses called eMoney Advisor. But I've used them off and on. They of course don't manage my investments, but like I had them do a Roth analysis for me earlier, I guess last year. And I've always been very happy with their services. And I think I would go to them. I would be honest and say, look, I'm scared, but I don't want to be paying 1% AUM. Can you help me set up a portfolio that's easy to manage? What would that look like? And how would I generate a paycheck every month or every quarter? Is that complicated? You may come away from that experience, maybe, saying, I don't want to do this on my own. And you'll stick with your current advisor. Or maybe you'll switch and you'll use Mark Zorrell or whoever else you might pick to help you through this transition. Or you might get comfortable and say, you know what, this turned out not to be as bad as I thought it was. I was kind of able to do it on my own. I had Mark or some other advisor there when I needed them for a period of time. And then after I got used to it, I was okay to do it on my own. But I think that if for those that are really looking to want to transition, that might be a good way to think about it. And that way you don't go from someone else doing everything to they're gone, you've got no help, and you're doing it all on your own. So I thought that was an idea that might be useful to some of you. So there you go. That's my answer to the first question. All right. Second question. A viewer wanted to know, they said, look, I've been in BND, and I'll show you what that is for those who don't know, but it's a bond fund offered by Vanguard. BND is just the ticker that identifies that fund. It invests in U.S. bonds. And it really hasn't done well over the last decade. So true. And I'm wondering, maybe a tips ladder is better. And so I want to give you some thoughts about this. And we're really kind of comparing apples to oranges a bit. So the first thing we have to understand is the difference between TIPS, which is a Treasury inflation-protected security. That's just the name they've given it. It's a U.S. bond that protects you against inflation. That's TIPS. We'll talk about that in a second. And then BND is an exchange-traded fund that invests in a bunch of U.S. bonds. But importantly, BND does not own any TIPS. So you don't have any exposure to TIPS if you invest in BND. So let me show you BND. Here it is. This is, again, the total Vanguard Total Bond Market ETF. It's an index fund, and it tracks a bond index that's put out by Bloomberg. And it consists of U.S. government bonds, mortgage-backed sort of agency bonds, think Freddie and Fannie, the mortgage-backed agency bonds. And it has some corporate bonds, all investment grade, meaning companies that aren't, as best as we know, aren't at risk of failing. And we can actually look at their portfolio and see that. Here we go, 50% in U.S. government bonds. There's 25% in corporate and roughly 2%. They call it securitized, think mortgage-backed securities. And they're all investment grade, which would be BBB or higher. So up top here, they don't have any what would be called high yield or junk bond or below investment grade bonds here. So it's a very secure fund. But as folks have pointed out, we can go to performance and let's look. Let's see, actually go to the chart. I want to look at 10 years. Let's see. Well, we'll go to max first. That's longer than 10 years, I think. Yeah, but you can see, I mean, it's been basically flat. It's kind of over the last 10 years. And actually, maybe we can do better. If we look at performance, we can come down here. Yeah, this is what I want to see. The 10-year made 1.18% over the last 10 years annually. So, it's been kind of, like I said, flat. And that's why folks are saying, maybe I should change. So you could build a bond ladder. Again, building a TIPS ladder is different in two ways. One, it's a ladder of bonds, which we'll talk about, but it's also TIPS, and this fund doesn't have TIPS. But you could build a ladder of just regular U.S. Treasury bonds. You could build a ladder of TIPS, or you could build both, right, or a combination of the two. And if we pop over here to Fidelity, this shows us the yields on U.S. Treasuries right here. And in the roughly 1 to 10 year range, we're looking at between 4.3 roughly and 4.6 is the current yield, right? If we go to the Treasury market, we'll just look at the 10 year for a moment. This is from the Fed. This is their economic data, the St. Louis Fed. And the current yield is about 2.25, 2.30. It's much lower, but remember, TIPS get adjusted for inflation. The principal amount goes up or down based on inflation. And so that's why the yields are lower. Investors are willing to accept a lower yield because they're getting that protection from inflation. And so, again, you could build a ladder with TIPS or with regular Treasury bonds or a combination of the two. And, if you wanted to build a 10-year ladder, for example, with 1-year intervals, you'd buy a bond or TIP that matured in 1 year, another one then 2, and all the way up to 10. And when your 1 year matured, unless you were spending it, you could take the proceeds and just roll it into a 10-year TIP or U.S. government bond. And you could just keep this rolling, I'm just using 10 years as an example, this rolling 10-year ladder. So would that be better than BND? And the thought was BND can lose money at times, but with an individual bond, as long as you hold it to maturity, you're not going to lose money. And so I think there's a trade-off here. I don't think there's one right way or wrong way. One is not inherently better than the other. It is true that BND can go down in value from year to year. And in fact, if we go back to Morningstar, we can see as an example, in 2021, it lost 1.86%. And then in 2022, it lost minus 13.11%. But here's the thing to keep in mind. Folks will often say to me, Rob, if I'd owned an individual bond and I didn't sell it, I wouldn't have, the bond may have gone down in value had I chose to sell it. But if I don't sell it and I hold it to maturity, I won't lose money. And that's true. And with a bond fund like this, there is no maturity, right? Because they're constantly buying and selling bonds, and they own over 10,000 bonds. They're constantly buying and selling to maintain the investment objectives of this fund. However, in 2022, you didn't have to sell either. And now you say, well, I haven't made it all back yet. That's true. But there is a way to at least estimate what your future returns will be on a bond fund like BND. And what we do, the first thing we need to know is the effective duration, and we'll call it 6 years, and you double it to 12 and subtract 1. So, right? So over the next 11 years, what's this fund going to return? Roughly its current yield. And its current yield, that's the SEC yield, is 4.61%. Right now, the irony is, for people that want to get out of B&D because the last 10 years it's not done well, it's in a much better position today to do well going forward than it was when we all owned it. And by the way, I still own it, 5 or 10 years ago. Now, I'm not suggesting that B&D is better than a bond ladder. I think they're both reasonable. B&D is certainly a lot easier to manage. You just invest in one fund and you're done. If you wanted tips, you could invest in a tips fund and you'd have 2 funds for your fixed income, which is what I do, and you'd be done. If you want a bond ladder, it's some work. You got to, it depends on how long the ladder, if a 10-year ladder, if you want bonds to mature every year, you don't have to, but you could maybe have them mature every 2 years. But you're buying multiple bonds, potentially both regular bonds and tips. And then when those mature, unless you're spending the money, and maybe you are, but if you're not, then you're reinvesting. Again, it's not all that complicated, but it's certainly a lot more work than investing in 2 ETFs, for example. And so that really comes down to what you're looking for. I personally have not felt the need to complicate my investments with a tips ladder or a regular bond ladder. That's just my choice. You may choose differently. I think the one time where I might consider a tips ladder is if I wanted to know exactly what I was going to get when the bonds matured on an inflation-adjusted basis and I intended to spend the money. So, for example, I may consider building a tips ladder at some point in our retirement to cover some amount of our fixed expenses over a 10 or 20 or 30-year period. I haven't made that decision at the moment, but I might choose to do that at some point. But again, I wouldn't be rolling the money over when it matured. I'd be taking it out and spending it. Anyway, it's a great question, and that's my take on it. My personal preference, ETFs, just easier and simpler, but certainly a tips ladder or a U.S. Treasury bond, or you could do a corporate bond ladder for that matter, can work as well. All right, question number 3. A viewer wanted to know, are target date retirement funds a good option? Are they reasonable? And the short answer is, I think they're excellent options. Again, there are always trade-offs. I want to show you one. We'll look at Vanguard's. So Vanguard is just one of the companies that offers target date retirement funds. The way these work, you invest your money in just a single fund. You pick one of these. We'll talk about them in a second. Vanguard will then take your money and they'll take some of what you've invested, put it in U.S. stocks, some in international stocks, some in U.S. bonds, and some in international bonds. They do that for you. And they do it all for a reasonable fee, which we'll talk about. The thing I like about it, particularly for folks that don't want to spend a lot of time thinking about all this, is they're easy to pick. You just pick them basically based on the year you plan to retire or the closest year. They're in 5-year increments, and that's generally what you see, whether you go to Fidelity or BlackRock or somewhere else. And so if you're going to retire in whatever, we'll say 2056, you might pick this fund to put your money in. And we'll just look at this as an example. Again, this is the ticker that's just a unique, in this case, 5 letters that identify this specific fund. In fact, just to show you how the tickers work, if this is new to you, I'm going to copy it. I can bring it over here into Morningstar. You go to Yahoo Finance, Google Finance, do the same thing, and they know, oh, that's the ticker because it's unique. Yeah, we know that what that fund is, target date Vanguard 2055, and we can look at all kinds of information here about the fund as well. But let's stick with the Vanguard site, and we can look at the portfolio itself. The first thing I'd point out, expense ratio looks like it's 0.088 basis points, really inexpensive. And if we go to the portfolio, it will tell us what it invests in. So it puts about 55% in U.S. stocks, 34, we'll call it 35% in international, and roughly 10% split between U.S. bonds and international bonds. But they do this for you. They rebalance for you. And then what's going to happen as you get closer to retirement, this asset allocation in this fund will change over time, and it'll get more and more and more conservative as you get closer and closer to retirement. And we can look at one. So let's say you put this in and we fast forward, and we'll just say you're about to retire today. So I'll pick this 2025 fund. You're going to retire this year, and we can look at the portfolio composition. And now you can see 2 things. One, they've added some short-term inflation-protected securities. So those are, we just talked about TIPS, right? 7%. They've got another 33% in U.S. and international. Oop, no, let me back up. I guess they've got 30% in U.S. stocks, 20% in international. They've got 30% in U.S. bond and 13% in international. So that's 43, 7% in TIPS. So that's 50% bonds and 50% stocks. Now, this is one area, though, where I will caution folks. I find that when a lot of target date funds get to the point where you're going to retire or even in retirement, they may get too conservative for me. And so there could come a time when you'll decide maybe that target date retirement fund is not right for you. It's too conservative, or maybe it's not conservative enough, depending on what you'd like. One of the things I'll say is you can always choose, and again, we're talking about inside a retirement account, so there are no tax consequences of buying or selling inside your retirement accounts. You can always say, you know what, yeah, it's 2055 and I'm retiring, but I don't really want a 50-50 portfolio. I want a little more stock. Let's just see what their 2035 portfolio is. Go to the portfolio composition. So it's 41 and 26. So that's 67% stocks. Let's just assume for the moment you're comfortable with that. You could say, you know what? Yeah, I'm retiring in 2025, but I'm going to put my money in this one for now. Now, you got to keep in mind, it too will start to change, right, as the years go by. And so in some number of years, keep an eye on it, you may have to change again. But it's a single fund. It's very inexpensive. And I think it's a great way to invest. And I've actually thought about moving some of our retirement funds into a target date retirement fund. And I wouldn't pick 2025. That's too conservative for me. I don't know which one I'd pick. But I think they're very reasonable funds. Now, you have to keep in mind that not all target date retirement funds are created equal. For example, Fidelity has both index funds, target date retirement funds that use index funds that are relatively inexpensive. But they also have target date funds that use actively managed funds and a lot more expensive. And so you have to keep an eye on what is offered perhaps in your 401k at work. I tend to want to stick with index funds, but I think they are great options. So that's my take in a few minutes anyway on target date retirement funds. Question 4. If a person has over $250,000 at a broker, say Fidelity, should they open up another account, whether it's at Vanguard, Schwab, M1 Finance, or perhaps another broker elsewhere, sort of spread the risk? Now, here's what this person's question is getting at. Brokerage accounts are protected by what's called SIPC, and folks, I think, make the mistake of assuming it's similar to FDIC insurance for a bank account, particularly because the amount's the same, $250,000, but they insure very different things. So FDIC insurance, as we know, if the bank goes belly up and they don't have your money, the federal government will step in and make you whole. Now, keep in mind that with a bank, banks don't file for bankruptcy. If they run into trouble, state regulators and federal regulators take over the bank. They often sell its assets to a healthy bank, not always, but it's often the case. And they'll make you whole up to the limits of FDIC insurance, because when you make a deposit at a bank, checking account, CD, savings account, it's the bank's money. It goes on their balance sheet and they can invest it as they want to, subject, of course, to the laws and regulations, right? You can't deposit your paycheck in your checking account and then say to the bank, oh, I want you to invest that money this way, right? That's not up to you. The bank decides how they're going to invest that money, whether it's a car loan or a credit card portfolio or a mortgage. It's up to the bank. It's their money, but they have a contractual obligation, of course, to give it to you when you want it. And so that raises the real risk. What if they don't do a good job investing that money and they go belly up? Well, we've got FDIC insurance. The government steps in, takes over, and you get your money back as long as you haven't exceeded the limits. Brokers are different. When you give your money in a brokerage account and you deposit it at Fidelity or Schwab or Vanguard or M1 Finance, it's not their money. They can't take that money and go invest it however they want. In fact, we get to decide, right? That's why you log into your account, whether it's a 401k, an IRA, a taxable account, and you decide, for example, to invest in a target date retirement fund, as we just looked at. That's your choice because it's your money. They're holding it on your behalf for your benefit. It's not on their balance sheet. What that means is if they go belly up, and they can go into bankruptcy, unlike a bank, their creditors can't come and take your money, right? They can't say, hey, Fidelity, I'm a big creditor. You owe me a lot of money. give me this person's 401k account or their IRA account, Fidelity would say, sorry, that's not our money. That's not part of the bankruptcy estate. That money belongs to someone else. You can't have it. And that raises a question, then what's the SIPC, SIPC, $250,000, why do we even have it then? Well, because what happens if there's fraud? What happens if a broker steals your money, right? Well, it can kick in and cover you then. Now, big brokers, Fidelity and Vanguard and Schwab, they typically have excess insurance. And you can get information on your broker's website about how much excess SIPC coverage they have. But they do have significantly more coverage than what is mandated by law. But again, it covers not when a broker goes bankrupt. If a broker went bankrupt, but there was no fraud, no one stole the money, all the money was there, they just couldn't pay their bills, you'd still have your money. It wouldn't have gone anywhere. And you wouldn't need SIPC or any other insurance to cover you. But of course, if there's fraud, if the broker is corrupt or whatever, and they steal your money, then that's when it's designed to kick in. Having said all of that, yeah, I don't think you need, personally, I don't go and open up another broker just because I've reached $250,000. Now, I do think it's a good idea not to have all your investments in one broker. It's not so much for that reason, but you think about cybersecurity, hackers, if there's ever just an issue with a broker and they have an outage and you can't get to your money, I like to have more than one, but it's really for that reason, not to somehow get more insurance coverage on the brokerage account. At least that's my approach. So there you go. All right, great question. Number 5, our last question of the day. How do we rebalance assets in Boldin? Boldin is a retirement planning software that I use. We've talked about many times. It used to be called New Retirement. How do we rebalance assets in Boldin? If we enter a 60-40 portfolio today, after a few years, markets change. It's now 80-20, which means it's a software. Boldin software is not rebalancing it automatically. How do we do that? And secondly, a B&D question. Remember, we looked at this Vanguard bond fund just a minute ago. What rate of return do you use for B&D? Well, these are great questions. And I will say that for me, I avoid all of those questions. I don't think we need to answer any of them, actually. And that's true whether you use Boldin, Projection Lab, Prelana, or some other retirement planning software, because they don't need to know our asset allocation. And let me explain why. So this is a demo account in Boldin. And I've just gone to the account section right here. And I just opened up, but this is a 401k. I've just thrown in a balance. You'll notice at the moment, there's nowhere to put your asset allocation. They don't even ask for it. And that would be true even if I connected an account. This is just a demo and I just threw in a number. But if I connected this to whatever, let's say Vanguard, and pulled in $1 million 401k, all it's going to bring in is the balance. Boldin doesn't need to know how much of that $1 million is invested in stocks versus bonds. It doesn't need to know my thoughts on the future return or rate of return for B&D. It doesn't need to know any of that. It does need for me to set an optimistic rate of return and a pessimistic rate of return. And I do use asset allocation to do that. And so if I've got a 70-30 portfolio, as an example, I'll go and look at what 70-30 portfolios have returned over the last, 30 to 50 years. You can use Portfolio Visualizer to do that. Vanguard has some resources. And I tend to put whatever that is, I make that my optimistic. And then for my pessimistic, I roughly cut it in half. This is not quite. I might go 4.5. And then when I'm running my analysis, I tend to use the average of these two. And in Boldin, you do that by simply picking the average right here. So let me save that. And then I'd go here and I'd pick average. And for that retirement account, you can see, you probably can't read it, but it averaged out to 6.75%. And that's a conservative, to me anyway. You may not think it's conservative. Of course, you can put in different numbers if you want. But that's kind of my primary analysis, is the average. I'll look at the pessimistic. I'll look at the optimistic. But that's kind of what I do. But you'll notice there's no rebalancing in Boldin. I don't need to worry about that. Now, if my asset allocation in this account in the real world changes significantly, let's say I go from 70-30 to 50-50, okay, then I do need to come in here and make a change, but I'm not really updating asset allocation. I'm updating my expected return, optimistic and pessimistic, right? So I avoid questions about like, what should I have the B&D rate of return? Now, Other software can be a little different. Prelana, for example, allows you to drill down a little bit more. I'm not sure how useful I personally find that. Let me show you one more real quick. Projection Lab. So Projection Lab allows you to actually customize your bond allocation. Now what I do, I say don't use the bond allocation. I don't want to know what it is. But here, and again, this is a demo account, but I can set the dividend rate, I can set the growth rate, and then I can set the bond allocation, and I can change it over time, even through retirement, if I want to have a different glide path. So I think it's a very interesting feature, but separating out the dividend rate versus the growth rate is tough. I think if I were going to do anything, if I were going to do this, I'd probably just set the growth rate to 0. And I'd come in here and I would set the dividend rate, I call it more interest rate, but to whatever the current SEC yield is for the total, in this case, the total bond market fund, if that's the one I'm using, 4.61%. I probably would do that. But that's just not, I don't do that. Even when I'm using Projection Lab for my own planning, and I do test all of these with my own planning, although right now Boldin is my tool of choice. I don't do that. I just have I don't customize the bond returns. I think it just overly complicates it, in my mind, unnecessarily. And I just do the same thing that I showed you in Boldin, figure out what my asset allocation is for the account, and set it at that. There are some limitations in Projection Lab at the moment that I think probably make Boldin a little bit better, but I do think that's something that's going to be changing with Projection Lab, maybe even this year. But the short answer to the question is, I don't worry about asset allocation in retirement planning software. I just worry about what expected rate of return I put for each account, and for that I do use the asset allocation of that account to calculate that. So there you go, 5 great questions. As always, I appreciate them. Hopefully you found this useful. You can ask questions in the comments below. Be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.